let's dive into a unique topic: how governments account for living things, like forests, livestock, and crops. These aren't your typical assets. They grow, change, and sometimes die. Enter Ipsas 27, the international standard for public sector agricultural accounting. It sets the rules for recognizing and valuing biological assets, living plants and animals, on government balance sheets. Before Ipsas 27, countries used wildly different methods, making comparisons impossible. Now, governments must regularly assess and report the value of their living assets, ensuring transparency and accountability. This standard helps answer: are public agricultural programs effective? Are assets growing or declining? Ipsas 27 turns complex, living systems into clear, comparable numbers for everyone to understand. To understand Ipsas 27, you need two terms: biological asset and agricultural produce. A biological asset is a living animal or plant, like sheep, trees, grapevines, or fish. Agricultural produce is what you harvest from those assets: wool, logs, grapes, or caught fish. The key is the moment of separation. The cow is the asset, the milk is the produce. Ipsas 27 covers only the living assets and the initial harvest, not the land or post-harvest inventory. Once produce is harvested, it's accounted for under Ipsas 12, inventories. For example, trees are biological assets until cut down. Then, the logs become inventory. Land, buildings, and equipment are handled by other standards. Ipsas 27 keeps the focus on the living, growing part of the operation. This ensures agricultural activities are reported accurately and consistently. How does a government first record a biological asset? It's called initial recognition. The asset must be controlled, expected to bring future benefits, and reliably measured at fair value, less costs to sell. For example, a forestry agency controls its trees, but not wild deer. Suppose a state buys 50 dairy cows for $75,000, plus $2,000 transport and $500 vet fees. The fair value is $75,000. Transport and vet costs are expensed. The journal entry: debit biological assets, dairy cows, $75,000. Credit cash, $75,000. This puts the cows on the government's balance sheet, ready for ongoing management and reporting. Biological assets change in value as they grow or decline. Ipsas 27 requires governments to remeasure these assets at fair value, less cost to sell at each reporting period. Any increase or decrease is recorded as a gain or loss. For example, if our herd of cows grows in value from $75,000 to $90,000, that $15,000 increase is an unrealized gain. The journal entry: debit biological assets, dairy cows, $15,000. Credit gain from change in fair value, $15,000. This keeps the balance sheet accurate and reflects real changes in asset value. If values drop, losses are recorded the same way. This approach gives a true picture of how well public agricultural programs are managed. It's a dynamic process, not a static one. The main goal of agriculture is to harvest produce from living assets. Harvesting marks the point where accounting shifts from Ipsas 27 to Ipsas 12. At harvest, produce is measured at fair value, less cost to sell. This becomes its inventory value. For example, a government orchard harvests 10,000 kilograms of apples at $2/kg. Transport costs are $1,000. Inventory value, $10,000 x $2. $1,000 $19,000. The journal entry: debit inventory, apples, $19,000. Credit revenue from agricultural produce, $19,000. The apple trees remain as biological assets while the apples are now inventory. This process ensures harvested goods are valued consistently and transparently. Not all biological assets survive. Losses happen. When an asset is lost, it must be removed from the books. This is derecognition. The loss is recorded as an expense at the asset's last fair value. For example, if a cow valued at $1,800 dies, the entry is debit loss on biological asset, $1,800. Credit biological assets, dairy cows, $1,800. This reduces the herd's value and records the loss transparently. Accurate loss reporting is crucial for reflecting the realities and risks of agricultural management. It ensures financial statements remain honest and up to date. Sometimes, a biological asset is reclassified as inventory, like livestock processed for meat. At the transfer date, the asset is remeasured at fair value less costs to sell. This value becomes the inventory's initial cost under Ipsas 12. For example, 100 fish valued at $1,500 are processed for sale. The journal entry, debit inventory, processed fish, $1,500, credit biological assets, live fish, $1,500. This moves the value from biological assets to inventory, ensuring a seamless transition. The process maintains clarity and consistency throughout the asset's lifecycle. If you found this helpful, like the video and subscribe to the channel for more accounting insights.